This slide is about something that you know already, and there's nothing to panic about. This slide is about something that you know already. Bond valuation. How do you value a bond? This is not something that you must be worried about. It's being repeated here. How much would an investor pay to purchase a bond today, which is redeemable in 4 years' time? It's being redeemed at its nominal value or face value of 100 and pays annual coupon at 5% on the nominal value. The required rate of return for a bond in this class is 4%. As with any asset valuation, the investor would be willing to pay at the most the present value of future income stream discounted at the required rate of return or yield. Thus, the value of the bond can be determined as follows. These are the coupon amounts, isn't it? The interest. And in the final year, there's 5 plus 100, 105. You discount at 4%. And this is how you find the discount rate. Now it's important to learn new things. 1.04 to the power minus 1. They say you multiply by 5 multiplied by 1.04 the power minus 1. Now some of you may remember that this 104 the power minus 1 is the same thing as what? That's what it is. This one, 1.04 to the power minus 2. 1.04 the power minus 2 is 1 over 1.04 the power 2. Is that okay? I want you to try this on your calculators. Learn something new. The discount factor. Please learn something new. Can you put in your calculators 1.04 to the power minus 1? Check the answer to get. Can I have the answer, please? 1.04 the power minus 1. What do you get? 0 point? 0 point?
.962.
0.962. What if you just divide like this? Divide 1.04. What do you get?
I'm getting 0.962, the same amount.
Yes. So it's important to learn something. So when we discount, we find that what's the value of this bond? The value of this bond is 103.62. Now, this is what we did in the question that we looked at, so that is not something strange. What of this one, this slide? Is it a new thing? No, it's not. Bond values versus the yields or the required rates of return. or the cost of debt. Remember in our class last time, we tried to value, we started with the 3.5. We found the answer. Then we went to 4.5. We found the answer. We came to 2.5. We found the answer. And our conclusion was that as you increase the yield, what happens? As you are moving this side, what happened to bond price? It will continue to drop. And that is the line that we are, the curve that we are getting there. So this is something we've already confirmed. Let's just read about it. If the required rate of return was 6, then using the same calculation method, the price of the bond was 96.3. And where the required rate of return is equal to coupon rate, remember, where the required rate of return or the cost of debt is the same as the coupon. The current price of the bond will be equal to the nominal value, which is 100. Conclusion, there is an inverse relationship between the yield of a bond and its price or value. The higher the rate of return or interest rates, the lower the price of the bond. And the opposite will be true.
What was there?
But like we covered last time, it should be noted that this relationship is not linear, unless for very small changes. The relationship is convex, like what we see here. So that is why I said, here, what we are covering on this slide is something that you know. Let us start with the method, with the methodology or the variables for today. We're introducing you to the concept called a spot interest rate. Now, this is a new terminology we want you to understand. So what is a spot interest rate? The rate for the spot interest rate is the rate for borrowing a sum of money today to be repaid in a single sum on a specific future date. It is calculated by finding the discount rate that makes the present value of a zero coupon bond equal to its price. Let's continue with the concept of spot. For example, the 1-year spot rate is the rate for borrowing money today to be repaid within a single amount after 1 year. The 2-year spot rate is the rate for borrowing money today to be repaid with a single sum after 2 years. Ideally, the spot interest rates could be found directly as the quoted yield to maturity, gross redemption yield of a zero coupon bond of various maturities. However, in practice, most government and corporate bonds pay coupon as a single sum. So pay coupon, that is, are not repaid as a single sum. So most of the bonds, like the one we have come across here, most of the bonds like the one we have come across here, where interest is paid every year and in the final the redemption amount. So these bonds are not zero coupon bonds, no. During the term of the bond, there's interest. At the end, there's interest on redemption amount. But in a spot, we're saying that there's only one payment at the end. In this case, spot rates cannot be directly observed and have to be implied using a process known as bootstrapping. And this is what we want to learn. Those who wrote the exam in March, I think a number of them, they got a question where they have to do bootstrapping, which is not difficult, no, but you need to practice it shortly before the exam. So let us see what bootstrapping is all about. Annual spot yield curves are often published by the financial press. I want you to pick this information. These are often published. We have seen what a spot yield is all about. So the annual spot yields are often published. For example, the Bank of England regularly publishes UK government bond yields on its website. The spot yield curve can be used to estimate the price or value of the bond. How? We have a situation here. A company wants to issue, now look at this, wants to issue a bond that is redeemable in 4 years for its nominal value or face value of 100, and wants to pay, again, they want to pay interest of 5% on the nominal value. The question is, estimate the price at which the bond should be issued. This is a new bond. So at what price are you going to sell this new bond? It's not already trading, no. It's a new bond. So the question is, how are you going to value this new bond? The annual spot yield curve. Now you know what a spot curve, yield curve is, or what a spot rate is. For a bond of this class is as follows: 3.5, 4%, 4.7, and 5.5. An accurate approach to bond valuation is to strip a bond into its constituent cash flows and discount each cash flow separately at its related spot rate. Now, some of you say me, what does it mean? What does this language mean? Don't panic. Once a theoretical market value of the bond has been found, its yield to maturity can be estimated. So you want to see how that can be done. So this bond here, we're going to break it down into its components. The 4-year bond pays the foreign stream of incomes. That bond that we intend to issue, this is the way it will look like. So then, if you look at these cash flows, we can summarize them, we can simplify them into 4 separate cash flows. This one, this payment, this cash flow can be rewritten as a cash flow associated with a bond we call bond 1, which pays only one amount. That one is bond 2, which pays a single amount. That one is bond 3. And that one is bond 4. Now, some of you may say, wait a minute, what are we doing here, Mr. Pierre? What are we trying to do? Could please somebody remind us of the spot interest rate? What is a spot interest rate? What is a spot interest rate? According to our explanation. Because we've been given spot interest rates. So what's the definition of a spot interest rate? Spot interest rate, what is it? It's there on our notes. What is a spot interest rate? That will help us see why are we breaking down these figures? Why do we rearrange them into 4 cash flows? Let's come here. A spot interest rate is the rate for borrowing a sum of money today to be paid by a single sum on a specified future date. So this is an interest rate which we apply where there is only a single payment, one cash flow. So that's what a spot interest rate is. And these are spot yields. So this 3.5 is an interest rate applicable where you borrow an amount which will be paid or repaid 1 year from now in a single sum. So if you want to borrow an amount today and you pay it back a year from now, this is the interest rate. If you want to borrow an amount today and you're going to pay 2 years from now, this is the interest rate. So for a figure which is a year from now, that's the interest rate you must use. 2 years from now, 3 years from now, 4 years from now. So what I want you to do is to get the discount factor at 3.5 1 year from now, at 4% 2 years from now, 4.7 3 years from now, 5.5 4 years from now. I want you to find the discount factors associated with this. Let's go. I want you to give me the discount factors for each one of these. Want the answers now?
So for 3.5,
In
year 1, it's 0.9662.
Or just 66. So this is so this one, I guess how you found it was 1 over 1.035, or what we covered at 1.035 to the power minus 1. What of the second one at 4% in 2 years? What is the figure? Which is
0.
1.04 the power minus 2. What have you found?
0.925.
0.925. What of that one? 1.047 to the power
0.871.
871. And the last one,
0.807.
807. How is it now? Is it okay? Have we managed? All of us find those figures?
Yes.
Okay. So these are what we are going to use to discount the individual cash flows. Which individual cash flows? These individual cash flows. We are going to discount them. Here we are. So that bond has been split into 4. Your proposal has been split into 4. And now you discount them, discount them, discount, and discount. The sum of these flows is the price at which the bond can be issued, 98.57. So if a company wants to issue a bond and they want to pay 5% coupon rate for the next 4 years, given those yields, the spot yields, this bond must be sold at 98.57. This bond must be sold at 98.57. Have we picked something here? So,
Mr. Piri,
yes, madam.
for me, I just find it a bit confusing
Mhm.
because of the definition of the spot interest rate. Maybe I just didn't understand it. Didn't it say that the spot interest rate is the interest rate charged for an amount borrowed and paid back on a specific date as one amount?
Mm.
But in this case, the bond is not paid back as one amount.
Mm.
It was
Exactly.
paid back in bits.
Mm.
But then, okay, I don't know, I'm a bit confused.
No, actually, you're on the
I don't
right
know.
track. You're on the very right track. So, meaning that these interest rates that you have here, we need to be careful in applying them. These interest rates, what they mean is that if there was you're going to borrow an amount and you pay a year from now, that's the interest rate. 2 years from now, 3 years from now, 4 years from now. So if you're going to apply this, then you must break down this into 4 cash flows. The year 1 cash flow, year 2 cash flow, year 3 cash flow, year 4 cash flow. So if you're going to use this, you must split that into 4. and treat them separately, then at the end you add them up together.
Okay.
So treat them separately, at the end then you bring them together. So you have split up these amounts into 4 cash flows.
Which in the end up as one in the summed up.
Yes. Because ideally,
Does it mean like
Mhm.
does it mean like even those individual interest rates, they are in doing all this formula, in the end they're like summed up as well?
Yeah, but you see, we're not summing them up because what ideally could have happened, you need just a single interest rate for all of them. Remember when you are discounting, you need a single interest rate, but here you're not using a single interest rate. One cash flow is being discounted at 3.5, another one at 4%, another one at 4.7, another one at 5.5. Ideally, just use one discount rate and find the discount factors for a number of years. But here we are discounting using different discount rates.
Oh, yeah. Okay.
As we continue and do 1 or 2 additional questions, then you're going to get into the grips of this particular concept. Yeah.
Okay.
So at the end of the day, you have added all these.
Mr. P, can we say that
Go ahead.
can we say that the discounting of each cash flow is same as bootstrapping?
No, that is coming later. Bootstrapping is just working backwards.
Okay.
We're coming to that later. Bootstrapping is now coming here. What do we want to do here? We want to estimate the yield curve. The question that we are coming from, the 3.5%, the 4%, the 4.7, we are given. And we are told that these are normally published. But is it possible to work out these? That's a lesson we want to learn. Can you work out these? The answer is yes. There are different methods used to estimate a spot yield curve. And the iterative process based on bootstrapping coupon paying bonds is perhaps the simplest. And that's the one we're going to follow here. Okay. So this was what came, I think, in March. The students had to estimate or to work out a yield curve. These, the 3.5, 4, 4.7, you need to work them out yourself. So how do you work them out? There are different, we go, the government has 3 bonds, 3 bonds in issue that all have a face or nominal value of 100. Now you understand that. And these are redeemable. The first one, 1 year from now. The other one, 2 years from now. And the other one, 3 years from now. Since the bonds are all government bonds issued by the same institution, let's assume that they are of the same risk class, which is true. Let's also assume that the coupons are payable on an annual basis. Bond A, which is redeemable in a year's time, has a coupon rate of 7%. And its market value is 103. Bond B, which is redeemable in 2 years, has a coupon rate of 6% and is trading at 102. Bond C, which is redeemable in 3 years, has a coupon rate of 5% and trading at 98. So you know the market value, you know the coupon rate. Can you work out the discount rate? You see what we are doing here? We know the market value of the bond. The market value is known. This is known. And also we know the coupon rate. So then we're going to work backwards. How? Do not be scared. This is very easy. And all of you will understand it. So this is these are the values. Bootstrapping. So Mr. Nkunguru, now this is what we're doing. We're going to do the bootstrapping. This is the market price. That's the market price. That's the market price. This is the coupon rate, coupon rate, coupon rate. What is determine the annual spot yield curve? Let's go. Number one. The 1-year treasury note will produce a single future sum of 107 after 1 year. Therefore, its yield equals the 1-year spot. You are saying, no, that we cannot understand. Let's come here. The value is 103. So let's go. Year 0 and year 1. So this bond, if you buy it today, you buy it for 103. You are going to receive interest at how much? How much interest? 7%, which is $7. And also it's redeemable at par, which is 100. So what you're buying really is a cash flow of 107. So 1 year later, you're going to receive your 107. You're going to receive 107 here. So this 107, if you discount it, multiply by the discount factor, which you don't know, should give you 103. So these are the cash flows. So this, which can be calculated as 107 multiplied by the discount factor. So let us now calculate. Tell me what's the discount factor? Can somebody divide here? What do we find? Zero point. Could somebody divide, please?
0.9626.
9
9626.
or 963. Is it?
Yes.
So let's go. 1 over 1 plus the interest rate should give you 0.963. So what is this interest rate then? That's the one that we are looking for. So what discount rate will give us that? Okay. Let us solve that together. Let's solve that. I've just put a 1 here. So I want you to invent this. This goes there. And also this goes there, and this goes down here. So 1 plus R equals, let's go, 1 divided by 0.963. I've just taken this and that down. And please somebody simplify that for me. 1 divided by that, what do you get?
1.04.
1.0.
Oh.
3 decimal places, please.
Yes, 3 decimal places. 1.0.
1.0.
It's 1.038.
038. 88.
No, just 038.
Okay. So what is the R then? You take this one on this side. So your R is what? 0.038 or 3.8%. So the discount factor that will give you this is 0.38 or 3.8%. So you'll find the first discount rate, 3.8%. %. 3.8%. Or 1.07 divided by 107 divided by 103 minus 1, 3.88%. The same figure. Now someone will say, but what is this the same as what we did? Yes, it's the same. Remember, we have here 0 and 1. The market value here was 103. Here, the cash flow 107. So you say this multiplied by the discount factor should give you that. So you have divided. So all you did is you now worked out the discount rate from this discount factor. So that was you have found the first one. Now where the bootstrapping comes in, Mr. Nkunguru, is the second bond. The market value of this bond and the coupon rate are given in the question. 2 years, the coupon rate is 6% and the value is 102. So let's arrange it then. So what we are saying is that this is a bond. 1 year from now, it will give you 6. 2 years from now, it gives you 106. Okay. Then you multiply by the discount factor. This discount factor is known already. This one is known. If you have got a single cash flow, repay 1 year from now, the discount rate is 3.88. And you already worked this out. You already worked this out. You already worked this out, and you told me it was 0.963. So here, 0.963 is known. The only rate which is missing is this one here, and that's the one that we are working on. So then, Can somebody multiply? 6 multiplied by 0.963. What do you get? Two decimal places. What do you get? 5 point. 5 point.
5.778.
78, like that. This one,
Yes.
106. When you add these two, they must give you the market value of 102. So I want you to solve for this now. So let us solve. Systematically, let us solve. That is also what is happening here. If you notice what's happening is still the same. 102 equals that multiplied by the discount factor. And this multiplied by what we don't know. We don't know these discount factors yet. So let's go systematically. This, you take it on that side. This one, take it on this side. Now together. So you got this equals 102 minus 5.78. So what is the answer?
96.22.
This is 96.22. Good. That's what they have also here, 96.22. Now, you divide that by 106. Divide that by 106. What do you find?
Uh, 0.908.
So this is the discount factor, which should go here, 0.908. Now, as we're not interested in the discount factor, what do we want? The discount rate which gives this discount factor. Do you get the logic? You want the discount rate which gives this discount factor. So you go back to your equation. 1 over 1 plus to the power should give you 0.908. Again, just invent these like what I did earlier on. Invent them. This goes on top, this comes down. This goes on top, this comes down. So you end up with 1 plus equals have you noticed that? Then you're going to take the square root of this. Take the square root here. And also take the square root there. So take your calculators, please. Take your calculators. In your calculators, you put in 1 divided by 0.908. You put in that in your calculators. Then you must say, to find the square root, so to the power 1 over 2. To find the square root, the power 1 over 2 or 0.5. So put this in your calculators and say to the power 0.5. What do you get?
I'm getting 1.049.
1.049. That's what we're getting. So that is 1 plus R. 1 plus R equals 1.049. So you remove 1 from here. So what is your interest rate? 0.049 or 4.9%. This is what you have here. 4.96 or 4.9%. So the discount rate then is 4.9%. 4.9%. Now, I'm sure the idea is coming slowly. I can't blame you. It's the first time you're doing it. The idea is coming slowly. Now, when you do the third one, I think you'll be much smarter now. I know all of you will be much smarter on the third one. So here we are. We have found that one. You have found that one. Now you want to find this one. So let's go. How many years now? How many years now?
3.
3.
Yes.
So there's a bond here. What's the coupon rate of this bond? Let's check it out. The coupon rate is here. What's the coupon rate? What's the market value? 9.8. Let's break it down. So this bond, what are the cash flows? Undefined way. And there's discount factors. Discount factors. This one, you already have it. 0.962. What of there? You already had it. This was 0. What? What was our discount factor from the rate you calculated? 0.908. Do you remember the 0.908?
Yes.
Yes, sir.
Yes. Then this is the one which is missing here. When we add all these, they must give us how much? When we add all those, we must get how much? 98. So let's put in the values, the present values now. Let's put in the present values. The first one, 5 multiplied by that, what do you find?
4.81.
81. The next one, you multiply here, what do you find? 4.54.
5.4.
5.4.
And the last one? The last one, what is it?
It's
105
105.
DF. Now you know. That plus that gives you 98. So this one, you take it that side. That one, that side. So what do you remain with now? You've got 105 DF equals 98 minus 4.81 minus 4.54. Please, can you do the subtractions there? So what do you have?
8888.65.
88.
0.65.
Yes. So we divide this side by 105. Divide this side by 105. So what is the discount factor that you're looking for?
That's 0.844.
So we have the discount factor. We have the discount factor, people. So the discount factor, which should come here, is 0.844. So the question is, what discount rate will give you that? What discount rate will give us this in year 3? You say that's not an issue. This is your equation. Again, remember what I told you? This one you say is over 1. So turn it around. What does it become? Can somebody divide there? 1 point.
1.185.
848.
1 point.
1848.
Okay. So you take the square root on the cube root. So how do you take the cube root? You go, you say 1.1848 to the power 1/3. Please, 1/3 must be in brackets. 1/3 must be in brackets. So what is the answer now?
One 1.058.
1.0.
58.
When you bring this side on that side, you've got 0.058 or 5.8%.
5.8.
That's what you have here. That's what you have. So the annual spot yield then is 3.88, 4.96, and 4.80. Now there's the issue of spot yield here. Can somebody interpret this like 3.88? What's the meaning of 3.88? What's the meaning of 4.96 and 5.8? Can somebody interpret that? If you borrow an amount payable 1 year from now in a lump sum, This is the interest rate that will be charged. If you borrow an amount which is going to be charged, which is going to be paid 2 years from now in the lump sum, this is the interest rate which is applicable to you. If you borrow an amount which you are going to repay in 3 years from now, this is the rate, annual rate, which is applicable to you. So that's the meaning of these figures. So these can either be given to you, like in the first question. Remember the first question they were given, or you can calculate like this. So these figures can either be given or you calculate. And we're going to take an exam question or you calculate, and you know we're going to see how we can key this into our spreadsheets. This is the same method. That's another approach there. Another approach arriving at the same answers. And the spot yield are still here. Now, what do you do with this annual spot yield? These, what do we do with this? We saw earlier on that were used to find what? The issue price of what type of a bond? A new bond. We used it to estimate the issue price of a new bond. Issue price of a new bond. Now, let us conclude our work. Let's close. As stated in the previous section, often the financial press and central banks will publish the spot yield curves. So you don't have to calculate. So this can be given. But if a spot yield is given to you, you must know how to use it in the exam. Okay. So these can be given to us based on government issued bonds. Yield curves for individual corporate bonds. Now, I want you to pick this. The yield curves for individual corporate bonds can be estimated from these by adding the relevant spread to the bonds. Now, some of you may say, wait a minute, this now sounds like what we did in calculating the cost of debt, where we say the cost of debt was what? Risk-free plus the credit spread. So to find how much investors are looking for, we take this. These are the yield curves, the spot yields. Then you add that. Yield curves for individual corporate bonds can be estimated from these by adding relevant spreads to the bonds. For example, the following table of spreads is given for the retail sector. Now, we have come across this before, isn't it? Remember, if a bond has got triple A, double A, single A, the credit spread for 1 year, 2 years, 3 years. If it's the double A, single A. So these, you add them to the spot yields. So for instance, our spot yield, year 1 was 1, 3.88. Year 2 was 1, 4.1.
196.
And this one was 5.1. 8. So
5.8.
the meaning is, if your company is a single A, You add this one and that one to find what investors will ask. If your company is double A, you add that one. If it's triple A, you add that one. For an amount which is payable 1 year, in 1 year's time. For 2 years and 3 years, you do the same. So you must understand what has the examiner given me. So if he has given you the spot yields, then you should add the what? A spread to find what the company should pay. This one here. So what is important is to know what is it that I've been given. Okay. Okay, so here Mason is rated as double A. Then each individual yield curve based on the government bond yield curves and the spread table above may be. So for Mason, what we do, we just pick. We just pick the 3.8, the 4.96. That's what we are going to do for Mason. We pick the 3.88, 4.96, and 5.80. And then we add accordingly the spreads associated with the spreads that are associated. So the spreads are here: 29, 41, and 55. So 29, 41, and 55. So we add. That's what we do. And when you add properly, you find that that's 4.17, 5.37, and 6.35. These would be the rates. These now would be the rates of return an investor buying bonds issued by Mason would expect. Therefore, Mason could use these rates as discount rates to estimate the price or the value of the coupon when it issues the new bonds. And Mason retails company existing bonds market price reflects its individual yield curve. So I hope we have seen where the story has taken us. Again, you've got a question here. A 3-year 5% coupon bond has the following spread above the treasury spot rates from the example I've looked at: 1, 2, and 3. Value the bonds based on the corporate spot curve. So I want you to value the bond. These are the spreads, basis points. That one, and that one. Okay? So these are the spreads. The yields, they are saying we must use and so you combine these to find the company's yields. Then you discount this bond here and find the market value. After that, find the estimated bond yield to maturity. Mr. Nkunguru, the bond yield to maturity is the internal rate of return. Find the internal rate of return. This is an exercise that I want you to do. So before the next class, there's this exercise. Okay. I will also post a question for you. I'll post a question, a past exam question for you. I want you to understand the concept of the spot yields and how to use the spot yields to come up with the market value of the bond. Please find some time to go through this. This is not beyond you, no? It's not. Go through these computations again. Make sure that you're happy with them when the exam is still far away. Okay. Are there any questions? Are there any questions?
Mr. Piri,
Yes.
hello.
Yeah, I can get you. Can get you. Go ahead. Mr. Kunguru, go ahead. We seem to have lost Mr. Kunguru there. Okay, people, this is where we end today. Please find time to go through this work. It's not beyond you. Go through it slowly so that in the next class you can just come up with questions to see clarifications. Yeah.